is that the items in the account, we want to look at your payment and your receipt for that period in cash. Your cash payment and cash receipt. All right. Now, these cash payments and receipt can be divided into three forms, right? Operating activity, investing, and financing. Operating activity now has two methods of computing it, which is the direct and indirect method. Direct method is where you have it to be cash paid to suppliers, cash paid to employees in form of salary, and cash received from debtors, right? Now those items are there, that are the distinct items that are different, that differentiates direct from indirect, right? Now that's that. Now these three of them, cash paid to suppliers, cash paid to employees, and cash received from customers. Ordinarily, you will see them in your financial position and your income statement, or a list of items given to you. But of course, this is professional class. You will see it in your financial position and income statement. All right. Now, for your cash paid to suppliers, you will see it in your purchases, and you see, in case you have to prepare an account for it. What do we call this account? Oh God, is it me something? There is an account that you prepare for it. I can't remember. I mean a name before the account. So I know it's payables and receivables contract. Memorandum. Memorandum is what I want to remember. So there is a memorandum of account that you have to prepare, right? And for the memorandum of account, you have the receivables and payables control account to be prepared, right? So in your receivables account, you can use your receivables account to determine the cost, the amount cash received from debtors, right? Where you have your cash, your sales, your credit sales, your cash sales, and all of that. Then also, you can have your cash paid to suppliers, which is from your payables control account, right? And also, we have cash paid to employees in form of salary and incentives. That's it. Then also, for the indirect method, that one makes use of your income statement and statement of financial position as well. For the income statement, if you look at the structure of your income statement, your income statement has how many, not components now. What do you call it, sir? Component of financial statement is income statement and statement of financial position. There's one name they call that one too. All the parts in your income statement. Oh, you will not hear me very well.
Is it elements?
Elements, thank you, sir. You will not hear this video very well when you are listening to when you are watching it on YouTube. Hold on, let me go back to my headset. Yeah, I think it will be better now. So yeah, we call it elements. Now the element of your financial statement. For your income statement now, the element will now be yes, what are the elements, please? Let's start with that. Elements of your income statement, what are they? Anybody? Element of financials, element of income statement. Yeah. All of them are expenses. All are overhead, indirect costs, indirect expenses, right? So in the element of your income statement now, you have your revenue, you have your direct cost and indirect cost. That's it, right? Whether it is direct income or other incomes, they are all revenue and incomes, right? Yes. Now, these elements, everything in your income statement, when your income statement is statement of income and other comprehensive income, and sometimes you call it profit and loss account, sometimes they can also call it statement of operations. Please, I have my voice is somehow right, so please bear with me today. Now, everything in your income statement can be regarded as statement of operation, right? So which means when you are preparing your cash flow statement, your operating activities, you can get everything in your income statement, minus some of them. There are some of them that you cannot get from the income statement. Do you understand? Now that's it. Are we there, please? Okay. Now, your statement of operation is your income statement, right? Now, aside that, we have your statement of financial position. What are the elements, please? Asset, liability, and equity. Now, the asset is divided into two, the liability is divided into two as well, right? Aha. And then we have equity, right? Now, your asset, your non-current asset, and your current asset is there. Your non-current liability and your current liability. Now, for your statement of operations, income, your operating activities for your cash flow, everything in your income statement, basically everything, apart from other incomes. That other income, I will explain there. Everything in your income statement is for operating activity. Your revenue, your expenses, and your direct costs. Now, your statement of financial position, we also make use of your current asset and your current liability for your operating activities. How and why? Now, when you are looking at your purchases, your raw materials of finished goods, I mean your production cost, your purchases of finished goods and the rest of them, you will see that in that purchases, there's an element of it that is in your current liability. If you purchase on credit, you have suppliers payables now, Abi. So which means everything in your current liability as well is part of your operating activities. Don't forget what is current asset and current liability. When we have the ratio of them, you are looking at how to finance your business using your current asset to finance your current liability, using your short-term asset to settle your short-term liability. Is that not what it means? Am I right, please? Am I right? Now, if that is the case, if you are using your current asset to take care of your current liability, that means we are saying that your current asset, like receivables, your receivables that can be paid within 12 months, is also part of your operating activities. All right. The only thing in your current asset and your current liability that will not form part of your operating activity is your cash in hand, cash at bank, and bank overdraft. Why? Because they are physical cash, and we have a column for them already. We have them as cash and cash equivalent. But aside that, your current asset and your current liabilities are in your operating activities. All right. Now the next one we have is so that means for your operating activities now, you have everything in your income statement apart from your other incomes. And when we say other incomes, it's many times it means that it is not the business that generated the income. When we say other income, I don't know if I'm right. It is not like it's not the business that generated the income. Yes, it is not the business that generated the income, or it is not the core sales of the business. That's not what the business is selling. Yeah, it's not your sales in the daily running of the business, day-to-day activity. So that's why we have it as other incomes. And what are those incomes that are in your other incomes? Yes, anybody? Disposal of assets. The company is not set up to be selling its own asset now. Abi? The company is not set up to be selling its own asset. So yes, disposal of asset is other income, and disposal of asset is not in your operating activities. It's not in your daily operations. The class ends in 15 minutes, right? Now, once the class ends in 15 minutes, please let's take 10 minutes break for those of us who want to pray. And after 10 minutes, we'll convert here immediately. Once the session ends, 10 minutes break, and then we'll meet again. So that's that. Now, disposal. Then what are the other incomes that we have? Dividend received. Now, dividend disposal of non-current asset is under non-current asset. Non-current asset has its own treatment under cash flow, so it's not be under operating activities. Dividend received has its own space in your cash flow statement, not in operating activities. Right? The business is not set up for investment purpose. So that's it. Alright? Now, those are the things. Now, let's leave operating activities and go to investing activities. When we say investing activities, the business invests in non-current assets. Your investment, the investment of any business is in the non-current asset. I'm not talking of the short-term investment where you have your investment itself that will yield under 12 calendar months. I'm not talking about that too. I'm talking about the non-current investment. For instance, now when you purchase plant and machinery is an investment, and it will give you a profit over its lifetime. Right? Let's say, and of course, plant and machinery is for 4 years. That means you generate revenue over 4 years on that asset. That is an investing activity. Investment itself is an investing activity. All your non-current assets are investing activities. So when you are talking of investing activities, just look at the element of your non-current asset. Now, don't forget, you have taken income statement, you have taken statement of financial position, right? Every other thing, for instance, statement of changes in equity, yeah, we have that. Let's leave that. So your investment or investing activities will now be your balance sheet as well as your what? Your asset register, which can be found in your PP in your balance sheet. That is that. Now we have the financing activity. Now in your balance sheet, you've taken the non-current asset. You've taken the non-current asset for investing activity. You've taken the current asset and the current liability for operating activities. We only have the capital side, financed by, which is your non-current liability as well as your equity. Am I right, please? Am I right? Am I right, anybody? Hello? Hey, I hope you can hear me. Can you hear me, please? Can anyone hear me, please? Hello? Mr. Isaac, are you there? Mr. Suleiman? Nobody is saying anything now. Okay. So I was talking about mentioning our balance sheet, right? And I said in our balance sheet, I divided our balance sheet into 4 places, right? Now I said that the non-current asset is for investing activities. The current asset and the current liability is for operating activities, right? Did I mention that, please? Did I mention that? Hello? 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 Hello, can anyone hear me? Yes, sir. Can you hear me? Can you hear me, sir? No, I'm not sharing the board again. I'm looking at all of us. I've been shouting hello now for the past few seconds, and nobody is responding. I hope you can hear me, sir. Was there any break in my network before? In the transmission, was there any break before? No, now we have about 7 of us here. All of us, our network cannot trip off now. All of us, our network cannot trip off now. How do I offend? How can I be talking all this while? And then the next thing I hear is that network trip off. And that's unfair. It's unfair on my own part, sir. Please, I hope everyone can hear me now. Okay. Okay, now let's continue. Now, I said that I've mentioned in our balance sheet, I divided balance sheet into four, right? Everybody, you can unmute yourself. You should only mute yourself if your place is noisy. If it is not noisy, please, you can unmute yourself. So I mentioned balance sheet divided into four. Abi, right? Now, I've taken, what's it called? Non-current asset. Abi, so non-current assets will be for investing activities. Abi, then current asset and liability. Current asset and current liability will be for operating activities. Abi, am I right? Current asset and current liability for operating activities. Then also we have only the finance by left with us. Only the finance by, and the finance by is where we have our non-current liability as well as our equity. Abi? Okay. Now that one will now go for financing activities. So we finance our businesses with those two things. Either you finance your business with equity or with shares. I mean with debt. Am I right? It's either you finance your business with equity or with debt. So that means those two are available for financing activities. Alright? That's it. Now, so that's that about cash flow. Any question on cash flow? That's that about separate cash flow. Any question? Okay, now let's go into uh, our consolidated cash flow. Now, for consolidated cash flow now, all right, just like we said, we have to add some things to it, and that is NCI. And also when we have associate and JV, we account for equity of the investment. Then also we have subsidiaries, acquisition and disposal, and also exchange rate differences on foreign subsidiaries, right? Uh-huh. Now, now, exchange rate differences. For exchange rate differences, right, we have it to be that they are not cash flows. Exchange rate differences are not cash flow. All right. Now, what are they? They are mere provisions. All right, they are provisions, and that's why we don't treat them as cash flow. For instance, now I bought an item at 1,000 US dollars when exchange rate is at 1,000 naira per dollar. All right, now how much is the item worth? 1 million naira. The item is worth 1 million naira. Now, at the time I wanted to make payment for that item, exchange rate has reduced from $1,000, 1,000 naira per dollar to 900 naira per dollar. So how much am I paying? How much am I paying in naira? $900. I thought you meant 900 naira. Okay, so we have it to be 900,000 naira. Now, the difference between them is the exchange difference. 100,000. Now that 100,000, is it an actual payment? Is it a cost? Or is it an income? No, it's not. Do you understand? It's not an income. How much did I pay eventually? I paid 900,000. Do you understand? That one will only affect our receivables and payables. They are not the actual cash flow. It does not involve actual movement of cash. Alright? So that's what we have there. Please, you guys should permit me, since we'll end this class at 7:30 tonight. Please, it's possible we end this class at 7:30. Probably will not do calculation on cash flow statement. Please. Now, so that's it. So it is not a cash flow. It only affects your profit or the profit of the group. Alright? Oh, and session is about to end. And I said we should take 10 minutes break. Oh my goodness. Let me see how many minutes we have on this session. 3 minutes. Please, we are joining back immediately. We are joining back immediately. Yeah, we are joining back immediately. We are not taking that minutes again. Yeah. Now, so for the adjustments now, then, yes, they are not cash flow. Then we have the adjustment rule under the indirect method. If there is any exchange loss is an expense. If you are using indirect rule, now indirect rule means that you are starting with net profit, right? Your net profit, add non-cash items. After you add non-cash items, you also look for the changes or differences in your, what do we call it? Changes in your what now? Adjust non-cash items. Adjustment for non-cash items first, right? Adjustment for non-cash items, then you now have changes in your current asset and current liabilities. We call it working capital. Changes in working capital, which is current asset and current liability, right? Now, in your net profit, exchange loss must have been added, must have been expensed in your income statement before you arrive at net profit, Abi. Do you understand that now? Now, that means that exchange loss that has been deducted from the net profit, you need to add it back because it is not a cash movement. And if it is an exchange gain, you less it, right? Because it's also not a cash movement. Then also you adjust for NCI share in any exchange rate movement. Alright, if you have any NCI in your exchange rate movement, you adjust for it when computing your dividend paid to NCI or individual. I mean, dividend paid to NCI, and that's it. Now, for your NCI, dividend paid to NCI, it is the only cash flow related to NCI unless there is a subsidiary acquisition or disposal. The dividend you pay to your NCI is the only cash flow. But yeah, let's end it ourselves. So we are talking about the NCI, right? Are we together? We
Yes,
mentioned
sir.
the you're looking at NCI, right? Now, for dividend, we said only flow paid as dividend, right? Only cash flow paid as dividend is what we refer to as our payment. Only dividend paid. Do we understand, please? Now, this dividend paid is the only cash flow unless there is acquisition or disposal of subsidiary. Now, it is shown under cash flow from financing activity. Do you understand? It's shown under cash flow of financing activity, and exchange rate differences must be excluded as well, right? So that's it. Now, associate or joint venture under equity accounted investment. For associate or joint venture, right, the note is that associates and joint venture are outside the group for cash flow purpose. So we don't consolidate their cash. All right, we only show the cash flow between them and the group, the movement of cash between the associates and the group. But aside that, it's a joint venture or associate. We don't consolidate them ordinarily, so we should not consolidate them as well. All right, so that's it. Then also, the profits are included in the group's P&L account under equity, but are not cash flow. I was having a discussion with someone sent a message to my alumni group, Oliver alumni group, and the person was saying that they had a net profit. They've not received dividend though, but there's a net profit of about 5 million naira, and dividend received was, or they've not even received dividend, or they received a dividend of about something. I can't remember the real story. So how do we treat it? Now, in my own contribution to them, I told them that dividend received is different from dividend approved. It's different from interim dividend. Now, dividend approved is assumed as dividend paid. Do you understand? Because once a dividend has been approved at the board meeting, it means nothing else can stop it. It has to be paid. Right? But if it is not that, then you can't assume it. Then the person was now saying that the company bought a company, and then a dividend was shared. Now they've not received the dividend. How do you record it in your account? It's two different things. Net profit, the profit earned by that business, once you are consolidating, you consolidate the profit as well. But profit is different from cash flow. You can have a net profit of 10 billion naira and your cash flow will just be 5 million naira. Do you understand? Your cash balance in your bank account may be just 5 billion naira and your net profit is 10 billion. Does it mean the account is wrong? No, it is possible like that, because part of your net profit is credit sales. I don't know if I'm making any sense here. Does anyone understand what I'm saying here?
Yes.
We are with you, sir.
Your credit sales is part of your uh, net profit.
Profit. Yeah.
It's not cash flow, but it is a profit. So in this case as well, profits are included in P&L account, not cash flow. So if you are looking at my profit and my net profit is saying that I have 20 billion naira in my account, like 20 billion naira profit, that is not my cash flow. My bank balance can be just 10 billion naira. And in fact, my account balance can be 40 or 50 billion naira. It doesn't have to be. In fact, most times it is not the same thing, except if you are doing cash payments, cash transactions only. like cash basis, cash payment, cash receipt. That's the only thing you record. That's the only thing that can make you have the same thing. If not, it will not. I hope I'm making a sense here. So that's the issue, and that's what we have.
Yes, sir.
Yes, sir.
Then also adjustment under indirect method. You have to deduct group share of associate profit from operating profit because it is a profit, not cash flow, and add group share of loss. It is a loss, not a cash flow. Then dividends received from associates is not a real cash flow. It is shown under investing activity, but that is not the real cash flow. The dividend received is not a real cash flow. Now, subsidiaries acquisition or disposal. The purchase price paid or received, yes, is an investing activity because cash was paid or received. Net cash acquired is shown separately, or net cash disposal. And you may need to analyze the difference between the total consideration and the net assets acquired. That's analysis, right? So that's it. The summary of everything we've said so far is here. Alright, so where to present is under investing activity, you present it as a single line, and acquisition of subsidiary, you present net of cash acquired. Net of cash acquired. That's what we have here. Now, disclosure requirement. What are you to disclose? You give us a breakout. Alright, your fair value of net asset acquired, everything, the cash consideration, the issue of shares, total consideration, all those things are to be included. Then you avoid double counting in working capital. This place is very sensitive. Avoid double counting. Don't forget in your single cash flow statement, I told you that the differences, changes in your working capital has to be adjusted, has to be recorded, or movement in working capital. In the same vein, we have it here. But when you have a subsidiary, if your subsidiary was acquired during the year, your opening balances are not part of the last year's closing balance. For instance, now, if my opening balance for this year in my my inventory is 5 million naira. During the year, I acquired a business, and the business had an opening balance of 1 million naira. At the beginning of the year, January 1st, that I opened my own account, my opening inventory is 5 million. But before the end of the year, I already have another company, a subsidiary that has an opening inventory of 1 million naira. So it is not the same anymore. So the opening balance are not part. So if I am to use the closing balance, opening balance, if I'm using the closing balance minus opening balance difference, there will be double count because my closing balance has included the opening balance of that subsidiary that I acquired in July. I don't know if that makes any sense. Does it make any sense?
Not really, sir.
Okay, so I'm using January to December. My inventory at the beginning of the year is 5 million naira. No, yes, let me use inventory. 5 million naira. I acquired a company in July. And don't forget, when you're acquiring a company, you acquire all the assets and liabilities as well. Abi? Am I right?
Yes, sir.
Now, the asset I acquired, my closing balance is now showing 20 million. Ordinarily, if I'm to do the changes, I am to do 20 million minus opening balance of 5 million. Abi? Ordinarily. That will give me the changes in my inventory. Abi? Closing balance minus opening balance. Am I right?
Yes, sir.
Now, but don't forget, during the year, I acquired a business that has another opening balance of 1 million. Now, if I'm looking at my own closing balance, their closing balance and my own have been matched together. Is that not so? The new business I acquired, the closing balance of my business and that other business have been matched together, right?
Yes, sir.
Now, but their opening balance is not part of my own opening balance. My opening balance is different. Their closing balance and my opening balance, closing balance can be the same, but opening balance is different. That opening balance, I need to remove it. So let's give an example. Opening balance is 120,000. Closing balance is 190,000. And then I acquired the business during the year with a balance of 40,000. Do you understand now? Now, ordinarily, if there was no acquisition there, it would have been 190 minus 120, 70 million. Right? That means my inventory has increased at the end of the year by 70 million. Is that not so? Do you understand what
Yes,
I'm
sir.
saying? But don't forget that
Yes, I
70
do.
million, that 190 million that I have at the end of the year has an opening balance of 40 million from that subsidiary that I purchased in July. Do you understand?
Yes.
So
Yes,
that
sir.
40 million, I have to remove it from my closing balance. So it will now be 190 million minus 120 million opening balance minus this 40 million. So that is now what will determine whether I have a more inventory or less. Do we understand, please? Do we understand, please?
Yes, sir.
So that is what we have there.
Yes.
So that's
Yes,
what we
sir.
have there. That's the adjustment. Now, the same thing you do to inventory is what you do to every other asset, current asset and current liability. Any question? Any
So
question?
this only affects working capital. This adjustment that you're saying only affects working capital.
Because working capital is one that usually have opening balance. All right. So that's what we have here. Now, when you acquire an inventory, you subtract it from the opening balance, or add to opening balance. When you acquire an inventory from your subsidiary, you subtract. But if the inventory is minus, negative, then you add. That's the whole thing, the general rule here. All right. Subtract that opening balance from the closing current balance. That's it. Now this one will ensure the movement reflects only the operating activities, not changes due to acquisition. All right. That is what we have there. Are we there? Hello, are we there?
Yes, sir.
Okay. Now, if there is disposal, then of course we reverse the case. For disposal now, cash flow is shown separately as well, right? Cash proceeds received is also shown separately, and that is that about it. Now, for PPE 2, when figures are at net book value, when you have your carrying amount, right, and there is an acquisition during the year, you adjust for that movement too. All right, you adjust for it. You subtract the PPE acquired through acquisition, because that one too is like the opening balance. Hello, we subtract it as well,
Right.
the opening balance, so that we can know how much of our assets changed during the year. Are we together, please?
Yes.
Aha. So that is what we have
Yes, sir.
under that. I hope I can proceed.
Yes, sir.
Okay. Now, so you remove the PPE, dispose to isolate only the purchases. Okay? Only the purchases. I hope we are together.
Yes, sir.
Aha. So that's it.
Yes.
So that is that. Now, the depreciation as well, you add back depreciation as a non-charge item. Add back depreciation as a non-charge item. I hope that makes sense. So that's it. Then any other thing, let me see if there's any other thing. I guess that's all. So yeah, for loan conversion, other non-cash transaction. For loan converted into equity, there is no cash flow. Finance lease, when you buy finance lease, there is no cash transaction in finance lease. Asset revaluation, there is no cash. Am I making a sense?
Yes.
Asset revaluation, there is
Yes.
no cash.
Yes,
But
sir.
sorry, what do we do? What should be the action?
It means
And you add back.
you add back those ones that you have deducted, you have subtracted, you add it back.
Okay, add back.
Yes, please. All right. So that's what we
No,
have.
what I mean, what? Sorry,
Go
sir.
ahead,
What
sir.
I mean is the I mean, loan converted to equity.
It will not
So
affect
since
cash
there's no
flow.
cash flow, okay.
It will not affect cash flow at all. All right. So that's it. Any question from anyone?
In terms of assets and revaluation, if there is an increase,
If
so
there's
to
an
say,
asset
maybe
revaluation,
we saw with
whether gain or loss, asset
a loss,
revaluation
yeah.
is not cash movement. It is not cash
And the
movement.
treatment we add, maybe we add back if it's a loss, then we subtract if it's a gain.
If the gain has been included in your income statement, subtract it. If it is a loss that has
Okay.
been included in your income statement, add it back. It is a
Right.
non-cash
Okay.
item.
Okay, sir.
Okay. Any other question from anyone? In the absence of question, please, let's meet in our next class. I apologize for cutting short today's class. Please, in our next class, we are solving question on cash flow. Yeah, cash flow statement. Before we come to the
Okay,
class,
sir.
cash flow statement in our next class, please. Good night, everyone.